Okay, welcome folks. We are in volume 6 of the Inner Circle Traders Market Maker Collection. We're going to be dealing specifically with the ICT buy model. Okay, and I know majority of my readers and listeners over the last 5 years dealing specifically with Forex. Uh, a lot of the concepts that I use in my trading actually stem from my days as a futures trader. And the market maker profiles actually go back to the latter stages of my commodity trading before I actually made a full segue into foreign exchange and trading spot. But we're going to deal with, again, primarily with the ICT buy model, but we're going to talk a little bit about the ICT sell model as a jigsaw puzzle um, perspective. In other words, how these two models mold together to give you a larger framework of what market structure is doing and how you can blend between the two and really trade without a bias, because I get a lot of questions about, how do I know what bias I should be trading for that particular day or that session or so and so. And a lot of the questions that are sent to me with that vein will be answered between Market Maker 6 and Market Maker 7. Okay, and again, it will not be a complete uh, you know discussion because it will be utilizing these two models in our specific trading concepts portions of this series later in this video series, predominantly the last three of the 12. Now again, if you have been following my work, you'll notice that this is a rather abstract fractal pattern that I have shared with the populace in the foreign exchange universe. Now, again, this is just my quick and dirty way of viewing market structure as it drops down into a level of buying interest for the smart money and what uh, may unfold as subsequent price action from the drop down into a support level. So let's talk about specifically what is an ICT buy model. And the first stage, obviously, when we're looking at this, again, very abstract uh, design, if you will, this area here, beginning on the left side of the overall pattern or model, is the initial consolidation. And this consolidation in the first green box on the left side, okay, is the building blocks of the initial drop lower. Okay, and the second stage is what is referred to as the run to support. Okay, and now what I'm doing is conceptualizing the overall framework of what builds the idea of an ICT buy model. Okay, I'll move down into a support level that will cause some measure of buying and then the subsequent price move higher. The third stage in the overall model is the smart money reversal. Now, 99.9% of the retail universe do not know how to trade at these levels. Okay, they don't want to be buying when it's most bearish. They don't want to see the market screaming down like this. Okay, because it's going to cause a fearful um, reaction in them. They're not going to anticipate the market moving higher. What will happen is that they're going to be anticipating a continuation lower based on uh, the previous market action. Okay. Now, for this moment, as we're discussing, it's not important that we understand what specific time frame we're looking at because it's applicable on all. So, as I'm describing this, until we actually talk about the ICT kill zones session specific, that being the London Open, New York Open, and London Close and Asian session, those are going to be dealt with later in the series. But for now, just understand the building blocks that make up this pattern and how we can learn to anticipate it in our charts. It's one thing to talk about it in an abstract form like this, because I get a lot of flack from folks that are not really willing to put the work into learning it or seeking out and studying it. They want an ABC, here it is how it happens all the time type of approach to trading it, and it's not going to be that easy. It took a lot of years for me studying price action to be able to identify this stuff in advance back here at this stage in during the initial consolidation, then expecting the run to support, and then the smart money reversal at the low. Okay, and then there is an accumulation, which is going to be the low risk accumulation buy. Okay, that's the first of the blue area on the overall profile. Then we have the next higher blue area. Okay, and this can be a little bit tricky. Okay, and this is where higher time frame directional premise is going to be advantageous for you. Okay, because this is the very area here that will many times, if you're wrong on your prognostication of on the higher time frame where the market's going, and higher time frame can mean as much as a 1 hour charts perspective if you're seeing the market maker profile occur on a 5 minute chart. So if you see that on a 5 minute chart, again, you're going to be referring to a higher time frame, and you may not necessarily be referring to a weekly chart or a daily chart. It could be simply a measure of 1 hour or 4 hour or even a daily chart. But you'll learn that it's many times not necessary to go beyond the scope of two higher time frames. So again, keeping in line with what we've done in the past, 5 minute is subordinate to 15 minute, which is subordinate to the 60 minute. And again, if you're seeing this price pattern form on an hourly chart, the hourly chart is subordinate to the 4 hour, which is subordinate to the daily chart. And obviously, if you're seeing it form on a 4 hour chart, 4 hour subordinate to the daily chart, which is subordinate to the weekly chart, and so on. I'm not going to beat it in the ground. You get what I'm saying here. But the fifth stage of the overall ICT buy model is going to be tricky for those um, traders that are looking for app solutions. It's going to have to be exactly as it's described here or conceptualized, and it's not going to always be like that. You'll see many times that the pattern itself will create a not a continuation long here, okay, or a reaccumulation, okay, which is described here conceptually. What it'll many times uh, provide us is an area for redistribution. Okay, much in the same area that we have in the second stage of the ICT buy model here. In this red area, once the move out of the initial consolidation takes place, this red area is when we anticipate another move lower down into an area of support, or what would be deemed an area of uh, buying interest. Now, again, we don't anticipate retail buyers. We're anticipating institutional, bank, large, deep pocket traders. Okay, that's the premise to what we're looking for in the charts. And I think if you're a new trader, I think if you're honest with yourself, you're thinking, what is everyone else on the forums looking to buy at? Because that's what their perspective is, and it's rather myopic. And I was the same way on America Online. I was looking for the guys that were going to be trading the cotton market and pork bellies when I was in futures. And can't trade pork bellies anymore, but nonetheless, I was anticipating seeing the views, if you will, of other traders. And I guess I was expecting, in honesty now, looking back, I was hoping that I would find someone that felt or seemed honest in their opinions or analysis, and I would just cling on them and see what they were going to trade. And I would look to do that. I never found anyone that was trustworthy. So, but I know looking back in retrospect, that's really what I was looking for. I was looking for someone to hold my hand, because it was a scary thing for me. I didn't want to put real money into the marketplace. So I know a lot of you folks that are just now warming up to my concepts. This is a higher level concept. It's not like, going in there and looking at, trend line breakouts. This is going to take a little bit of work and study. And this is one of the tricks to expecting, okay, failure. Okay, and I don't want you to come through this video series thinking that this is the panacea be all end all to market analysis, and there's nothing that's going to be infallible. It's going to be perfection, from the beginning and to end. It's going to be plagued with times when you aren't correct in your interpretation of what price action is suggesting to you at that moment. And I'm telling you exactly where this is going to occur at. Okay. You may see the initial consolidation, the run down to support, the smart money reversal. Okay. And then a low risk accumulation stage in here where you buy and you see the reaction and you think, okay, well, it's going to be another reaccumulation in here and then move lower. I'm sorry, move higher to take out this consolidation, which is the classic clearing of the initial consolidation where stops would be resting above it. And it won't happen. Sometimes what will happen is you'll see the initial consolidation, the run to support, the smart money reversal, the low risk buy, and right up here it'll run a little bit higher just to make an optimal trade entry selling opportunity right at a pre-existing bearish order block that may reside inside of the second area of consolidation outside of the initial consolidation, or a return to the bearish order block from the initial consolidation that caused the move going lower. So in other words, this may look all, for all intents and purposes, look like a perfect ICT buy model, but in fact, midway through, it changes gears and becomes a classic selling scenario. Okay, where you could be selling from an optimal trade entry at a bearish order block. Okay, and that again is going to be largely hinged upon your understanding of higher time frame directional premise. Now, if you are willing, and this is going to be a very, very big pill to swallow for most of you, if not all of you, if you're willing to accept being wrong, and I'll say that one more time, if you are willing to accept being wrong sometimes and not being concerned about being absolutely 100% right at this area of the profile, okay, you will still, it'll still serve you very well. You'll see a lot more insights that the retail universe generally doesn't grasp or doesn't get from looking at charts. And again, the the initial consolidation is kind of like what we learned already about crouching above a order block. Okay, and this area in here where we have a run to support, that is absolutely what you're anticipating. This is the consolidation above a existing order block, and then you'll see a move sharply lower into a support level. Okay, and then you'll see the underlying price actions moving higher and higher into each stage, and then ultimately clearing the initial consolidation where stops would obviously be building and resting above that consolidation in the form of buy stops, because those participants that would have been lucky enough to be riding this lower and unlucky enough to be riding it back up, eating up all their open profits, they will be neutralized here. Okay, what your mindset is, you want to be looking for this particular pattern. Okay, and now we're going to talk about some specifics. What is it that you're specifically looking for, or what should capture your eye or perspective on the market at any given time where this price pattern or fractal uh, should be forming? In other words, where should this particular pattern take place? Because it's one thing to see it conceptualized and abstractly shared like this, but you can't trade this. You can't see any price. You don't even know what price you're referring to in this. Okay. Again, it's very vague. It's very abstract, but you have to have a building point, okay, or a foundation to build upon. Then, as you see many, many sample sizes on a daily basis, on a weekly basis, of multiple asset classes, not just Forex. Okay, you should look at stocks. You should look at bond markets. Okay, commodity markets. Everything that's tradable, you'll see this phenomenon take place. Even Bitcoin. So if you see these patterns recurring over and over again, okay, this is what went through my mind. I would see the market move out of consolidations or trading ranges, drop down sharply, and then had this absolutely stellar bounce off of a level that made no sense to me at the time. Okay, but a week or two looking at the charts, I'd go back and say, wow, look at this thing. Back here, somebody knew this was going to go up here, obviously, and the participants that were buying it down there, I want to be a part of that group, and no one was teaching it. What I discovered initially when I was on America Online, I know some of you know that I'm very arrogant and pompous and egotistical many times when others challenge me in my um, ability as a trader. That's the old me. I don't like it being shown too much, but sometimes the old me just comes out. I know it may put off some of you, but I'm being honest, it's me, and I used to be a lot worse than that. But on America Online, when I first started making money, this is the late 80s, I'm sorry, not late 80s, late 90s. I was very proud of myself with what I was able to do initially. And I had entered a room where a teacher, and he admitted he hadn't been trading very long, but he was teaching his concept or understanding of Wyckoff. And when I got to the point where he was describing some of the terms about jumping the creek and breaking the ice, and it sounded hokey. It really did sound hokey, and I get why some of you that have watched my stuff uh, made fun of some of the things I described as, for instance, the Judas swing. I got a lot of flack for that, and I know what that's like for you to hear those types of things and feel that it's silly, so let's make fun of it because it doesn't make sense to you. That's the same thing I felt about Wyckoff, when you will see in a couple of minutes when we get to some of the concepts and theory that he was sharing. And this is old school stuff. This guy isn't like from the 90s. This is way back in the day. He had terms that he coined for the way he interpreted price. And I think that is one of the things that, as a new trader, and this is something that I did as well, we take it for granted that traders that are successfully um, able to dissect the market and discern what price is doing based on their own internalization of what price has done in the past. That is some of the strongest insights that you'll gain over time, and appreciation as well for what others are able to do in their interpretation of price. Not so much how do they trade, but how they digest, how they take in what the market's sharing, because we're all looking at the same thing. It's the same open, high, low, and close, but yet how is it that we have so many varying perspectives and yet still be profitable? Wyckoff, his theories, when it was first introduced to me, I just scoffed at it and said it was ridiculous. It's stupid. It made no sense because at the time I understood simply trend lines, moving average crossovers, stochastics divergence, and failing volume as price made a higher high. If volume was dropping down, volume precedes price. That's what I learned in commodities, and that is true. But you can't really discern volume in forex, so that's why we don't talk about volume in foreign exchange, because you're never getting the true volume. You're not seeing it. Okay, you may see it on your broker's level, but that could be in question as well. So we're not going to talk about volume, and I think it's rather pointless to even refer to it in the asset class of spot. But when we have our discussion about commodities, it will absolutely be essential because it's something you can be very sure about in terms of its measurement. But I just simply didn't have the faith of following or digging deeper into Wyckoff's material. And um, some of you that are reading and listening to this video that were around me in those days, I know a few of them have recently rediscovered me in the foreign exchange teaching circles, um, will remember me being very argumentative about everyone else's concepts and largely Wyckoff's at that time. It wasn't until I met someone on a institutional level that were sharing concepts on how they gauge accumulation and distribution on a institutional level, and it was basically largely hinged on looking for accumulation or consolidation, when the market drops down out of that accumulation area, okay, it would be a form of manipulation to gather either stops or to accumulate pending orders. And that was the beginning of my strongest understanding of how price action works. It taught me one of the most difficult lessons to apply to our trading is to be comfortable buying when the market's dropping aggressively. And it's a very difficult thing to do as a new trader, but I can assure you that's what you want to be doing. You want to be buying when it just doesn't feel right to be doing it. And the ICT buy model provides a basis or a foundation to doing that very thing. Um, and obviously, when we talk about the ICT sell model, it will be the same thing. When the market's just raging higher, it doesn't feel good to sell into that unless you have a foundation or a basis to hinge it on and why it would make sense to do so. So again, it's important that you understand that we present, or rather I do, present the ICT market maker profile, buy and sell models like I do. It's very uh, vague. It's a very simplistic perspective to hold on a market, but the don't discount its abstract nature, because it simply does get to the core of what price is doing. Because if you understand what each component of the profile or model is doing, or what it should be reflecting in price action, you'll be able to internalize what it is that the market is doing. Why is it gyrating where it is? Where should it go next? Because that's how we profit, right? It's not important so much what it's done yesterday or on the left side of the chart, in as much as it is going to be what it's going to be doing from the edge of your right side of your chart. We need to know what it's doing from that point on, okay? And it isn't until you do, months of study, not days, not weeks, months. It's going to be months before you can really sit down and immediately pull apart any section of price action and see these profiles. When they Once you see them and once you understand what you're looking for, you just can't just not see it anymore. You'll know exactly what it is that's going on in price action, and you'll see them very quickly. And you'll also be able to see them on a lot higher time frames, and you'll know, looking at certain price formations, that if you went down to a lower time frame, you'll see exactly what you would anticipate, either a buy or sell market profile. Okay, so let's dig a little bit deeper in what this profile can do for your trading. The building blocks really came from my first introduction to Wyckoff. And his idea was that the market will drop down and move into a consolidation where there is accumulation taking place. There is what we'll see here, and this may look similar to what has been described in a lot of my work as the Judas swing. Okay, uh, Wyckoff refers to it as a spring. Okay, it's a test to go lower, but it's quickly rejected. Okay, and I'm not going to teach Wyckoff here, because I do believe just the stuff I'm going to share, and it's probably only 3 slides in this whole series that you'll see from Wyckoff. They're the only things I think that are um, useful. Okay, and if you look at his work, you'll also discern rather quickly that he can describe it like this, but he's not going into a great level of detail on how you go into it and look for it live in your charts. Okay, it's one of those beautiful things like divergence. You look at an indicator in the past, they look at that, it diverged bearishly, and it would have been a perfect sell. But try doing that when you're in an uptrend and don't understand how that uptrend is performing in terms of where it is. Is it a new uptrend? Is it a mature uptrend? But even just simply because it bearishly diverged in an indicator doesn't mean anything. It could stay overbought for a long period of time and continuously make divergence bearishly and keep raging higher. And I actually got myself hurt a lot in commodities doing those types of things, just trading a stochastics divergence system and just not knowing what I was doing. So again, it's one of those things. Try not to be uh, too dependent on the the graphs I'm showing here because I'm just giving you a basis of how I got to the understanding of the ICT um, profile bull and bear. Okay, the buy and sell profiles. So Wyckoff's assumption was that as the market drops down, it goes into an accumulation phase. Okay, and many times it'll try to go lower and reject and bounce. Okay, and then this red line here for bullish scenarios, this is what he came up with as called the creek. Okay, and when it crosses that, it's called jumping the creek. Now I know it sounds a little silly, okay, and that right there, that was the very thing, jumping the creek and the spring. Those two things, I immediately dismissed it and paid no attention to it. I wish, in retrospect, I could go back in time and smack myself because I could have made fortunes well earlier than I have if I just would have spent more time looking at price action, because this would have spurred the insights I gleaned by looking at a particular market, and it was live cattle. Okay, live cattle. Okay, in 1997. Okay, 1997 is when I discerned in my own trading what this looks like, and I saw it just perfectly described as you see here, but I didn't see it with the understanding of accumulation, a spring across the or jump the creek, and they call it a throwback here. This is simply a retest. Okay, and then you move up rather sharply, and then go into a bull flag, and then a rally, and another retracement, and then continuation. The the point I'm trying to show here is that I didn't know how to digest what price action was doing. I was looking at this after the fact. Had no idea that during consolidations, that's where smart money was accumulating. What I was looking for was this thing right here, what's being described clearly right here, a breakout. I was looking for that to take place, then finding what we deemed as classic resistance turns support, then continuation higher, and then looking for what? Pennants, flags, symmetrical triangles, ascending triangles, all those types of things, continuation patterns, then looking for that, your trend line support going higher. That's how I traded initially. And then I discovered stochastics, and I thought I cracked the code and I was going to, own the world. That didn't work well. It made a little bit of money, but then suddenly the market turned around and it didn't work well at all. And you know what I'm talking about for those that have tried to be an indicator-based trader. The point of and the strength of what I gleaned from Wyckoff was his interpretation of what was going on behind the scenes. Because think about what's going on. If you can ascertain the framework of what's going on behind price, it doesn't matter, okay, that what's happened over here on the left side. You'll be able to digest what's going on as it's consolidating. You know what's happening. Someone's accumulating price. I'm sorry, accumulating positions. Now, you'll know quickly if we go below it in terms of breaking what would be deemed as support here. If it's quickly rejected here, and we're at a very higher time frame support level, or what would be deemed an area where it would be an interest for buyers. If we see that rejected like that, do you have to wait to be a breakout buyer here or a retest trader here? No. You don't even have to catch the very low down here. As long as you're inside this consolidation and the risk allows you in terms of your entry and where your stop loss would be realistically placed, you could be a buyer anywhere in this area and still be a participant in the subsequent move higher, which you would anticipate because of the accumulated positions during the consolidation at a higher level time frame support level or an area of potential buying interest. You would not need to see the qualifying or confirmation tools that we see with retrading back to a area of support resistance, bull flags in here. You won't need to see that. What'll happen is you'll start entering in areas of accumulation while it's in the consolidation. Then rallies out, comes back, gives you an opportunity, yeah, but many times you won't get this retest. It'll just scream against you, and then it'll consolidate up here. But would you want to be buying up here in contrast to buying, say, down here? What would be the more smart entry? Obviously down here, because your risk is limited to what you would discern below these lows versus buying up here. Where would your stop need to be? Who knows? If you put it below this low, it could still very well come back down deep and move into an order block that would be in this area here and take out this stop, or this layer, this level where stops would classically be building upon. Okay. And then, without going into further rabbit trails and such, I gleaned that this particular person had a way of understanding, again, broad-based, conceptualized, what's going on in price action. By having that understanding, that showed very well that I had a lack of that understanding. I was simply chasing patterns. That's what I was doing. When I was a commodity trader, that's what I was looking for. I was looking for classic chart patterns and no real understanding of what, trends were doing. I didn't understand it. I was looking for two perfect areas where a swing low would match another swing low if I drew a line between the two of it. And naturally, if it comes back down to that line later on, I'm going to be buying there. And that doesn't work. It doesn't work. Okay. I know 15 of you guys are going to send me 20 examples where it did, but I can tell you it doesn't hold up very long. I can give you examples of anything working for a little while, but what we're describing in this series is far and above beyond what is shared in books and texts and such. So I counsel you to, when you look at price action, come to the conclusion that you have to have a way of seeing what price is doing behind the open, high, low, and close. And I know that sounds rather vague right now, but when we start seeing some examples, you'll see exactly, rather quickly, what I mean by that. Okay. And when you start to do that with your trading and your study of price, you will get such a greater sense of confidence, because you won't necessarily be waiting for Gartley patterns and bat patterns and optimal trade entries. You'll anticipate accumulation, a break, and then distribution. Distribution, a break, accumulation. Okay? That's the whole basis of what ICT does. Okay? I'm looking for an area where strong buyers should come into the marketplace. How am I going to see that? Well, they're going to hold price in a small range. It's usually right above a bullish order block. And when price drops down to that order block, I know with absolute certainty that that is probably going to be one of the best buying opportunities of that particular time period. And I'll be all over it, assuming I'm awake. Caveat emptor. So looking at, what we're seeing here in terms of Wyckoff, it's, again, it's a rather vague conceptualized view of what price is doing. Can you look at this and say, okay, well, yeah, I've seen that 20 times in a price chart? Probably not. But when you have this idea as an example, then go into the charts and see when price had a strong rally out of accumulation or a consolidation like this, and see if it doesn't create these types of phenomenon. Okay, I shared with um, Chris Laurie's group. I was a member of his Pro Traders Club, his paid subscriber-based service. I was only with him for a couple months, but I was trying out his service, and I think it's a good service. But I shared a lot of the similarities between what I've learned over the years and what he teaches in terms of anatomy of a price swing, and the very strong not contrast, but the strong comparison between my market maker profile, Wyckoff's accumulation distribution cycle, and again, simply viewing the market in that perspective. And one of the essential strengths of Chris Laurie's teachings is that he makes it very apparent that while he is teaching concepts and ideas and such, he's leading the trader. And this is really what a lot of the work is done. You lead the trader to an area where they, on a personal level, internalize, digest, and view price in a way that makes sense to them. Okay. I view things in the form of they're out to get me, and I'm looking to snipe perfect precision entry points. When it's so loaded in my favor, I'm going to make money by default. That's how I internalize the marketplace. This another trader may look at this and say, okay, well, this is a casino, and this is what I'm looking for, and I'm going to play my hand when it's like this. That's their way of interpreting. Okay, does it make it any better that I'm an action-based, movies, movie show, perspective? Contrast that with the gaming theory of the casino. Absolutely not. There's no advantage over it. Okay, it just makes sense to me that they're out there to take my money, and the casino leads you to believe that you're in there to get money, and that's not what it's for. It's a business to take your money. Well, that's what this is. I view it as predatory. They're trying to be, a predator to my financial status. And by interpreting the marketplace with those ideas, it makes sense to me. Now, I'm completely aware that this may not resonate with some of you. It may not resonate with a lot of you, and it may be a sticking point for a lot of my teachings. And I'm okay with that because I'm perfectly comfortable with the potential for me not to adequately communicate this to a level where every single one of you readers and viewers are going to be able to digest it and use it. Okay. But those that aren't able to digest it and discern it now, I promise you, if you stay in the market and you look at price action enough, you'll come to this conclusion eventually over time because you already had the seed planted in your mind. Okay. Much in the same way I had it done in with back in my early days in White when American Lion, where Wyckoff was introduced to me, and even though I made fun of it initially, then the idea behind how he broke the market down conceptually, okay, not that it's a trading entry technique and it's a way to enter your trades. That made no sense to me. I could care less about that part. But the fact that he was able to, again, conceptualize something that was alien to me. I didn't understand what it is I should be viewing. Why should it rally? What are the precursors for a market that's going to rally? What does it look like? By having those ideas in mind, when you look at price, it's very advantageous. Okay, so let's continue on and look further into the building blocks of what led to the ICT market maker buy model. This again is just simply an image I snagged off of the internet. If it would have had credits, I would be able to credit them here. So if this is something you've seen before or know someone, or if this is possibly your image, um, I would have no problem giving you credit for it because I didn't draw all this business in here. But this is Wyckoff's logic as to what's going on. There is a selling climax that takes place, and notice here that this is what I saw a lot of times with the Wyckoff principles. All the examples that were shown in textbooks, and I have over 2,500 books now, either in electronic form or in printed form. And yes, it's a rather large collection. A lot of the regurgitated material you see in technical books and such, the reappearing images that are passed about generically, um, with Wyckoff, it's no exception either. They'll always talk about the selling climax, Okay, then it goes into a consolidation. Okay, this is the spring, and then the test, the false break lower, and then it shoots back up. It jumps the creek here. Okay, this is the cause. The effect is the price markup moving into a buying climax, another consolidation, which is being distributed, and another test. Then it breaks the ice. This is the support called, again, silly names, I know, but that was his way of internalizing what was going on. And then the effect, therefore, seen in price being marked down. Now, again, this looks all fine and great. And again, with the same approach to using it like we look at indicator divergence, we all can go back in the left side of our chart and find perfect, pristine examples of bullish and bearish divergence. And that would be working perfectly, nailing the very high and low of the marketplace. The problem with it is you can't apply it real time. Many times a divergence may be there at the moment as the bar is forming, but then all of a sudden the indicator catches up and the divergence just fades away. I'm sure if you've looked at any